Welcome to this month's Market Update. I'm joined today by Casey Lowe, Senior Consultant with Frontier Advisors. Hi there, Casey.
Wayne?
So we're starting a new financial year now. I'm taking a signal from the green tie that last year must have been a reasonably positive one. Can you step us through some of the key points to consider out of 22-23?
So you're right. Yes, it's been a positive financial year, but despite that, there were a lot of volatility in financial markets. The financial year was characterized by shifting markets, where you think back early on in the financial year, there was a lot of instability driven by, inflation increasing rapidly, central banks hiking interest rates quite aggressively. We had geopolitical tension and just general concerns around a global recession as well. So quite a negative start to the financial year. But as the financial year progressed, economic activity was actually quite resilient. And expectations were that central banks were nearing the peak of the interest rate cycle, and inflation started to moderate. So a lot of that drove financial markets upwards.
Yes.
In particular, developed market equities performed really strongly. A large part of that was due to large US technology stocks, which was mentioned in last month's video by Chris, and which didn't really flow through to Australian equities because we have not as large of exposure to technology stocks, but we still delivered positive returns, largely driven by the resource sector delivering very strong returns there. And then on emerging market equities, because of China's reopening being a lot weaker than expectations, that had flowed through to Chinese equities and in turn flowed through to emerging market equities broadly. But emerging market equities still delivered a positive return as well. Going to other asset classes, because we've seen a sharp increase in interest rates, both credit and government bonds delivered flattish to slightly negative return for the financial year. And because interest rates have increased, we're now getting a modest positive return from cash, which is a big change compared to previous financial year where we're getting pretty much 0% from cash. And wrapping it up, foreign currency, because the Australian dollar had fallen over the financial year, that has provided a positive boost to investors with foreign investments.
So different outcomes across asset classes, but for a balanced superannuation fund investor, what did the year look like?
So it's been a big shift in performance for the financial year compared to last financial year. Remember, so in the previous financial year, the median balance option for super funds delivered about minus 3.4%. So it was quite a negative year.
Yes.
And it's been a big turnaround this financial year where the median balance option delivered around 8.5%. So very strong results. And in terms of longer term performance, it remains very strong. So although, the outlook for the global economy is still quite precarious and there's a lot of negative risks out there and markets may move around day to day, it's important to remember that superannuation are meant to be a long-term investment.
Very important to remember that, KC. The Reserve Bank of Australia, what have they provided the market to consider over the last month?
So after a period of hiking the cash rate very rapidly, they've taken a pause this month and left the cash rate on hold at 4.1%. The main reasoning behind that is they've increased the cash rate significantly over the last 12 months. So they've increased it by 4% since May of last year. And they just want to sit back and assess the impact on the economy. So that's happening there. But the main point I think to take is that the Reserve Bank have said that they continue to see a potential that they might have to increase interest rates further, but it's still dependent on how the economy develops and also how the inflation outlook evolves as well. So as a result, that the markets is still expecting the cash rate to increase further, peaking at 4.5% later this year, and for no rate cuts to come in until the latter half of next year. So market expectations is still for more hikes to come.
Right. So we're on a reasonably positive footing to start the new year, KC. I'm sure there'll be lots to analyse over the course of the next 12 months. Thanks for bringing us up to date today. And thanks for watching this month's Market Update.